Money, Master the Game by Tony Robbins. Tony Robbins is best known for his mastery of emotions and his teaching and motivation and getting people moving in their lives. In this book, though, he tackles the topic of money. A lot of people told Tony to stay in his own lane when he started talking about money, but I think that was because people were threatened by what he was saying, as he's trying to bring truth to our financial system. And in this book, there's plenty of lessons for all people about how to use money properly and how to build wealth. And the younger you learn this thing, the better it will be as you can build wealth throughout your life. Number one key, of course, and you've probably all heard it before, is to invest. And how do you make sure you invest? You pay yourself first. Take money out of your paycheck and invest it right away. Set it aside where you don't even see it. 10, 20, 30%, whatever you can do, 40%, maybe up to 50%. But save to invest, but don't just invest anywhere. We have to be wise in our investments. The biggest downside for most people in their investments is they just don't understand them, and they're putting their money in mutual funds and they're getting massive fees taken out of what they are earning. And over time, because of compound interest, these fees are limiting the wealth they're creating by hundreds of thousands, sometimes even millions of dollars by the time they take their funds out. There are tons of hidden fees in most investments. There's a reason why the Wall Street investors and why the brokerage companies have massive stadiums and massive skyscrapers, and people are getting paid millions and millions of dollars of bonuses. They know how to make money. We have to be careful with the fees. And another thing that's really hurting most investors is they're getting pummeled by taxes over time. Again, over time, that takes away what you can earn. It takes away what you can, the compound interest you can earn, costing you thousands, if not millions of dollars throughout the lifetime of your investing. Better to be investing in mutual funds than not to be investing at all, but investing in high-cost, high-tax mutual funds can be very costly to the common investor. Protecting it, how do you protect against fees and taxes? Look for passive investing, indexing. There's indexing that's taken off since Tony Robbins introduced this book. There are all kinds of index funds out there. Look for ones with low fees. In index funds, you're not buying and trading stocks like a mutual fund. You're actually buying the entire group of stocks that you're doing. So there's index funds in different industries. The best ones are index funds in the entire country, or the top 500 companies in the company, largest companies in the country. This way you can bet on the entire industry, or bet on our entire country, or our entire foreign country. So index funds are great because there's no fees to pay people to trade the stocks. You're buying them. Computers can run it, and they just buy the stocks a little bit at a time, and you spread your risk out over the entire country. If your index fund fails, the entire country is failing, which you might be in trouble anyway. Also, because you're not buying and selling, you're just buying and holding in the index fund, you're not paying taxes on every transaction. 3 keys to best returns: proper asset allocation, understanding where you need it, how many bonds, how many foreign, how many domestic to buy. Diversification. A diverse portfolio protects you against failure in any one area. And of course, tax efficiency. And then I threw another one here, eliminating fees, of course. So that's how you grow your wealth over time and can create massive returns because of compound interest. How do you defer your taxes? You can not pay taxes on things right now with a traditional IRA. The Roth IRA is great because you pay the taxes now, but you don't have to pay on the growth. So you're paying on what you put in, but not what you're growing when it comes out later. But you can't. With the Roth IRA, you take penalties if you take it out before age 55. Annuities pay later. Another way that you can. In the index funds, as you use index funds, these things, you're not going to be paying as many taxes. So that's a positive. Some people, if everybody talks about investing in real estate. Investing in real estate can be really great, but you have to understand it. If you don't understand it, you can buy real estate funds. It can be a portion of your portfolio where you basically buy pieces of real estate companies, and they actually buy the real estate. That can be risky, but it can also be a good piece of your portfolio. People are limited on what they'll do for financial freedom. Would you be willing to move for financial freedom? Tony Robbins talks about he moved from California to Florida because the taxes are so much lower. So think about, would you be willing to move to places with more opportunity and lower tax rates? A lot of people just accept where they're at, but if you're willing to make big changes, you can make big progress. One of the keys to investing is dollar cost averaging. That means you buy the same amount of funds no matter what. you buy every single month, because no matter what the market is doing, you cannot time the market properly. So just buy a little bit each month. If the market's down, you'll get many more shares, and then when the market goes back up, you'll reap the benefits to it. Do not try to time the market. That's what these investors do, and it's proven over time to be almost impossible to properly time the market. You need to have a good percentage of your funds in a safe bucket, particularly as you get older. The younger you are, the more aggressive you can be and take on more risk. The older you are, the more you need in your safe bucket. These are some items that can be in your safe bucket: money market funds, CDs, low-cost bonds, home pension funds, annuities, life insurance, some real estate things, structured notes. These should be in our safer investments, but they return less. And the older you get, the more you need in your safe bucket. You also need to have some in your growth bucket. These are riskier, more risky investments that could go down. You could lose money on them, but they also have the potential to grow much. Some real estate funds, obviously all your stocks and bonds and your indexes are higher risk. Mutual funds, high yield bonds, and commodities, these can all go up and down. And if you're older and they all go down, it can really hurt you. But younger, you probably have a chance to recover. And so more should go in the growth bucket, the risk bucket, the younger you are. Some models, 70% in the growth bucket, 30% in the safe bucket. Tony Robbins is a 60-40. He touts this Ray Diallo 4 seasons portfolio, which is actually kind of reverses it, because he said that stocks are 95% more riskier than bonds. So he recommends buying much more in the safe bucket than in the risk bucket. And this is designed to build wealth for people without taking any losses. So these people in the 4 seasons portfolio, they almost always gain no matter what, so they're never taking a step back when the market goes down. It's like a steady growth over time can have huge results. Ray Diallo has been particularly successful with this. I have an overview of his book as well if you're interested in one of his books. So in summary, Tony Robbins tackles the topic of money, and there's so much more in the book. I highly recommend the book for any old, young, or any investor, anyone who's trying to build wealth in their life. It was very effective. It's controversial because people were challenged by what he was trying to say, but I highly recommend the book, and there's so much more in it than what I just said here, but those were the basics. Hope this was helpful.